Hi everybody, Frank Finance here. Hope you're having a wonderful day. It's been a few months since we've talked about energy transfer, so I want to revisit the stock analysis I did several months ago. We're going to talk about the price target for energy transfer, 2021 Q3 results, business description, the stock price history, price performance versus some of its peers, some of the fundamentals and financials behind the company, dividend information now and moving forward, merger news, and my final thoughts on energy transfer as an investment. Before we get started, a quick plug for the channel. I do videos on personal finance, investing, and stock analysis such as this one. If you like this type of content, please consider subscribing. And if you find this video helpful, please hit that like button. Thank you so much. Now to your content. All right, so my price target for energy transfer is $12 to $14 in the next 12 months. That indicates a 22 to 42% upside. All right, for Q3 2021 earnings, energy transfer reported earnings per share of 20 cents. They compared to the analyst estimate of 30 cents, so a miss of 10 cents or about 33% there. On the revenue side, they beat revenue estimates by 1.65 billion, reporting $16.66 billion in revenue for Q3 compared to analyst expectations of 15.01 or about 11% beat. All right, so for Q3 highlights, energy transfer, as we mentioned before, they make a lot of their money in volume, and so what's good to see here is they recorded new volume highs that they had never experienced before, both in product terminal volumes and transportation and fractionation volumes, whatever that is. On the strategic side, you can see that they're still on track to close their previously announced merger with Enable Midstream Partners, looking to close in Q4. And then on the financial side, when it comes to debt reduction, we'll talk about outstanding debt later on when we get to the financials. But they were able to reduce it in the last quarter by $800 million, and that brings their current year-to-date to $6 billion in debt reduction. So real quickly, I wanted to address why earnings per share missed. So it missed by 33%. If we go to revenue, that was reported at 16.6, beating by 10% expectations, compared to the previous quarter at 15.1 billion. The cost of products sold is really what threw earnings per share off. So you can see that increase from 11.5 billion to 13.18 billion. So basically, for every dollar that they increased the revenue, they basically increased the cost of products sold. And if you look at every other line item going down through this statement, basically they're a couple $1 million off. So really cost of products sold is what is the biggest effector here of what caused earnings per share to miss by 10 cents or 33%. 20 cents per share is in line with what they reported last quarter. So that's at least good. There's some consistency there, but with an additional $1.6 billion in revenue, you'd expect that to translate down to earnings per share, what comes back to the shareholders. So that is a disappointment there. Definitely want to pay attention to that moving forward. Another thing here is one possibility here is that they did report that they had extraordinary volumes higher than what they had previously, or previous in history. So maybe they just weren't anticipating that volume, and so there's some additional cost that were associated with bringing that on. But we'll have to monitor that moving forward, because as we talked before, is energy transfer makes their money in the volume, and so as volume increased, you would expect the earnings per share to also increase. Now for the business description, energy transfer is in the business of storing and transferring energy products such as oil and natural gas. Their transfer capacity is quite high. A lot of their location is inside of Texas, Oklahoma, Louisiana. Transfer capacity, 69,000 miles of pipe, crude oil, 10,000 miles, refined products, 3,000, storage capacity. Natural gas is at 150 BCF, and crude is at 64 million barrels, and refined is at 8 million barrels. It's also helpful to know where energy transfer sits inside of the oil and gas industry. There's upstream, which is focused on exploration and production, midstream, transportation and storage, and downstream, which is preparation of the product and distribution at a consumer level. Energy transfer sits in the middle at the transportation and storage level, mainly storing and transferring oil and gas via pipelines. Before we continue with the stock analysis, there's one misconception that I just want to address real quick. Energy Transfer is paid based off of volume of oil and natural gas going through their pipes, not the commodity price itself. So as oil prices, and there's been a lot of news about oil prices as well as natural gas prices going up and increasing over the last year, it's not where they're making their money is because the commodity price went up. It's because volumes are going up because people are flowing more gas through the pipelines and the economy is opening up, so there's a need for moving more gas back and forth. So that is why things are looking up for them, and that's why the business is doing well. It's not necessarily because the commodity prices are going up, even though there is some sort of tie to it, because as commodity prices go up, producers want to produce more, and then therefore they need energy transfer. They need somebody to transfer the oil from place to place. Energy Transfer is in that business. All right, so looking at Energy Transfer stock price over the last 5 years, they're down about 30% over the last 5. If you bring that down to the last year, they're up about 77%. They dropped down into the right under $5 range for something. In the last 6 months, I did my last stock analysis on May 6th. I produced it that day at least, and it was trading around $9.20. It went all the way up and approached the $12 range that I had as the price target at the time, and still is as well, at $11.30. And since then, it's dropped all the way down about 23% if you bought it at the $11 range, to where it got low in the last 6 months at $8.73. And since that $8.73, it's popped and it's been up about 10%. To where it's currently trading at about $9.76 a share. If we look back at that 5-year range or even max it out, there's a very consistent range and a dip here. This is when oil prices corrected. And so you can see that its historical trading value is significantly higher than where it's currently trading, especially in the 5-7 years before COVID happened. There is a significant range here of upside, and so that $12 to $14 range, in my opinion, is pretty conservative. All right, next I want to look at price performance of Energy Transfer, some of its peers. So on this, we have Energy Transfer, KMI, EPD, PAA, which are all midstream providers, and then I have the SPY, which is the S&P 500, that is in green. So if you look over the last 5 years, all of them have underperformed the market significantly. It actually lost anywhere from 13 down to 65% in the last 5 years. If we lower that down to the 2-year range, all of those are still in the negative. SPY is about 50% up. Now in the last year, SPY is up 30%, and all these names are up, beating the SPY. Now the lower end of that is EPD. KMI is at 50, PAA is up 65%, and Energy Transfer is up 92%. If we go ahead and go to that back to the 2-year mark, you can see that in comparison of the drop, S&P went down significantly less than most of these names, and you can see most of these names have really consolidated as how much their price performance was over the last 2 years, with PAA significantly lower than them. So looking at the last 6 months since the performance, since I made my last video, you can see SPY is up 9% or 10%, PAA is up 14%, Energy Transfer is basically flat, and then the other two, KMI and EPD, are down about 5%. All right, jumping into the financials. If we look at total revenue for 2018, it came in at $54 billion, 2019, $54 billion, and 2020, big drop due to the pandemic, and it came in at $39 billion, about $14 billion, $15 billion off from the year prior. Anticipating for full year 2021 is going to be in the $67 billion range, so there is good revenue growth if we compare it back to the 2019 numbers. That's something I like to do on all these stock analysis. Basically, don't look at 2020 because, well, it's good to know the resiliency of how they did in 2020, but you don't want to look at their growth year over year compared to the 2020 numbers. You want to compare their growth compared to the 2019 numbers. So that $67 billion anticipated for 2021 Compare that to 2019. It's a really good growth rate from 54 to 67 that's anticipated. On the growth profit side, we saw that basically stay in line, so they were able to actually boost their gross profit margin quite significantly by cutting capex and some other things in order to do that. Same thing on EBITDA. Like, this is very impressive in my opinion that companies were able to do that. It also sheds some light on why can't we do these things moving forward, increase those margins, increase what EPS is coming back, earnings per share coming back to the investor. Would like to see that continue moving forward. I doubt it, but it just shows you what these companies can do from a resiliency standpoint when they really need to tighten up the purse there. So on the net income side, granted they had $14 billion in revenue loss in 2020. They lost about $650 million, down from about 3.5 billion the year prior. And then on the earnings per share side, you can see 1.38, 1.33, and they lost 24 cents on an EPS basis last year. And that earnings per share is expected to be higher than it was in 2019 for full year 2021 moving forward. So that's good to see. All right, now let's move on over to the balance sheet. So short-term cash and short-term investments is at 282 million, receivables at 5.9 billion. Total current assets at 8.2, and total assets at $96 billion. Going down to liabilities, total current liabilities at 8.5. That's slightly higher than the total current assets, and total liabilities at 60 billion compared to total assets at 96. Most of this debt here is in our long-term debt category. You can see from Q4, they had $51.4 billion in debt, which is very high for this company. But they've been focused and had a good first quarter, and they reduced a lot of the debt at that time. So you can see they've gone from 51.4 down to $45.6 billion in debt, and it's one of their key focus areas in order to continue paying down that debt. Now, I don't think it's going to be at the same rate as it was between Q4 in Q1, because they had I would say an extraordinary event with freeze in Texas that caused them to be able to put gain additional cash flow, and they used that cash to paying down some debt. But moving forward is going to be a key focus for them. All right, next let's look at free cash flow. So if you look at the last few quarters, you can see in Q2 they had 2.5 billion in cash from operations, minus 7.3, so about 1.3 $1 billion in free cash flow. For Q1, as I said, there was an extraordinary event. They had a huge increase in free cash flow here of about $4.6 billion. So that's incredible. This was a one-time event, probably won't happen unless there's some sort of similar event that occurs. About $800 million in free cash flow here. Another $1.2 billion in free cash flow in Q3 of 2020. Going back into the 2019 numbers on a quarterly basis, you can see that free cash flows, it looks fairly consistent. Not huge though. That's one thing concern here is I got 300 million, a little over 300 million, 400 million here, 700 million, and then another $400 million in Q4 of 2019. So hoping these free cash flow numbers increase. Looking at it on an annual basis, you can see they had for full year 2020 $7.3 billion in cash from operations minus capex of 5.1, so about $2.2 billion free cash flow. In 2019, that was still about $2 billion, and then the year prior in 2018 actually had negative free cash flow of about $400 million. So this is something that's going to be important, definitely a good valuation metrics, and it's definitely something to consider. All right, next up I want to talk about shares outstanding. The reason why shares outstanding is important is because if a company issues new shares, it dilutes your current position. In the reverse of that, if a company buys back shares, it actually increases the value of your current position as a percentage of ownership. Now in this case, if you see Energy Transfer went out and did an acquisition with an all-stock purchase of a company called ETP. They were previously called ETE. So when those two companies merged, it was an all-stock transaction, and so they're actually buying assets with the shares. So in terms of relative ownership, very little dilution occurred in this event. So this is one of those events where an acquisition can actually provide or increase your ownership stake. So it's not a huge issue to see shares outstanding when you're going and making acquisitions or mergers. That's not a huge issue. It's mainly when it's just compensation, or they're just issuing shares for continued operations. That's where you really want to be concerned. If they're issuing shares just for operations, that's a little bit of a problem. In early 2021 or early 2020, there was a slight increase in shares outstanding. I'm sure this was due to the pandemic, but it was not significant enough for me to be concerned about. And looking at their history over time, I don't know if this was a merger or acquisition back then, but consistently it seems like they've kept shares outstanding pretty much in line, very little buybacks. All right, looking at revenue estimates for 2021 and 2022. In 2021, analysts are estimating $65.73 billion in revenue. On the low side, $57 billion. On the high side, $88. I think that $88 is very far off. I don't think that's near realistic expectations. And that's 10 analysts. On December 2022, so full year 2022, they're estimating full year revenue of $65.58 billion. Low side of 56, high side of 79. Now, in my opinion, this number is going to go up almost for sure from that 65 billion, mainly due to the buying, the acquisition, the merger with Enable. So we'll talk a little bit more about that merger later, but it's just important to note that there probably will be a revenue boost just because of that merger. All right, moving on into dividend information. Last October, Energy Transfer announced they'd be cutting their dividend by about 50%. That moved their quarterly dividend from 30 cents down to about 15 cents a share. And annually, that moved from $1.22 to 61 cents a share. Their current dividend yield is around 6.26%. All right, so a little bit more on dividend information. So if we look at their dividend yield over time, you can see that it was decreasing moving up until the 2015-2016 range. They increased their dividend that year, but they had a huge decrease in the stock price. This I believe had to do a lot with the decrease in the stock price had a lot to do with commodity prices and how much was actually flowing at the time. And then moving forward, their dividend yield kind of settled around the 6 to 8%. And then in 2020, there were huge. The dividend yield was high, and that was mainly because the price dropped in half, and so you saw that dividend yield pop up accordingly. So Energy Transfer went ahead and lowered that quarterly payment down to where it's currently at right now. Around 60 cents a share or 60 cents a share on a yearly basis, 15 cents a share on a quarterly basis. All right, so next up I want to look at the dividend payout ratio. This is a good indication of how well and how secure the dividend is. So if we look at 2018 and 2019, we see that their dividend ratio or payout ratio was 96 and 86% respectively. Those are really, really high. Basically, everything that they're making in earnings, they are paying out in a form of a dividend. In 2020, that would actually went quite negative because their earnings per share went negative, and they were still making the same dividend payout. So you have to do that with debt, any cash that's on hand, issue new shares, whatever it makes sense to pay that off. They didn't issue new shares, but they had to pay that with debt. Moving forward, they reduced their dividend to around 61 cents on an annualized basis. So if you go, their dividend went from $1.21, it's going to go down to 61 cents. So that payout ratio, granted their earnings per share stays the exact same it was in 2019, which I expected to be a little bit higher for 2021 at least. That's going to cut that down into the 50%, 40% range. So that's going to be a pretty safe dividend in my opinion. And there will be a little bit of room for them to improve it. Now, I don't think they're going to improve the dividend in the short term. They're going to keep it pretty stabilized and to continue paying off debt to make the company a little bit more financially sound for years and years to come, and also make it easier for them to continue with their mergers and acquisitions moving forward. So I think this is a good and positive note on the dividend side. It's still a very strong dividend in terms of a percentage, 6%. is still very strong. As it moves up in the $12 range, that will lower, and they will probably continue to uptick if they see revenue growth. But the dividend is pretty solid and will more than likely not be cut again. All right, so next up, let's talk merger information with Enable, ticker symbol ENBL. So this is a $7 billion all equity transaction, so Energy Transfer is going to have to issue new shares. It's already been approved by Enable Midstream shareholders, so that will be closing by the end of 2021. And this will just add more capacity and more throughput for Energy Transfer in their pipelines and storage capacity for their energy products. All right, next up, let's look at the financials for Enable Midstream real quick. On the revenue side, they had revenues of $3.4, $2.9, and $2.4 billion for the last 3 years. That's 2018, 2019, and 2020. And on the EBITDA side, came at about $1 billion for all those years. On the net income side, it went from $521 million to $396 million, down to $88 million, which, even though it was substantially lower, it is positive to see that they actually were able to swing a positive net income and get some actual EPS on a positive side out to shareholders, where a lot of midstream providers, including Energy Transfer, actually had negative net income and earnings per share. So a little positive note there on that. It looks overall to be a fairly good deal for Energy Transfer, and it doesn't seem like they're overpaying too much for this acquisition. All right, so my thoughts on Energy Transfer. Overall, the revenue looks good for 2021. 2022 looks stable. I like that they're making acquisitions. Their free cash flow looks positive. I like that they're paying down debt. There's a lot of good things happening with Energy Transfer. On the price target of $12 to $14, I think that is definitely achievable in the next 12 months. I think it could happen relatively quickly. We've seen that happen. I think once this deal closes with Enable, we may see that happen. Now, in terms of price of the stock versus price of the commodity, I just want to send out a reminder here. They make their money off of volume, not off of the commodity price. Now, there is a little bit of a correlation, I would say, because as commodity prices go up, producers will start to produce more, which makes more oil flows. However, if the demand doesn't keep up with the supply, then they can make some money on the capacity side, where they're just storing oil. But really where they make a lot of their money is if there's more volume. So as the commodity prices go up, there will be a point at which there will be an oversupply, in which case commodity prices will go down. There will just be storage and less transfer. And so there will be I think there will be some sort of balancing that will happen over time as suppliers start to produce more. Just got to be careful with that. So going back to the price target of $12 to $14, when Energy Transfer hits $12 or gets close to that, I'm going to probably make another video of whether or not I'm going to continue to hold or sell Energy Transfer. There is a lot of up and down with this stock. It does have considerable upside, higher than $12, so that will need to be reevaluated with where oil prices are, how much producers are producing, and whether or not I think that the flow of oil is going to continue through their pipelines. And if that continues for considerably the foreseeable future, then I may consider holding. If I think that there's going to be some sort of correction or decrease in amount of oil being sent through the lines, then I will probably sell and then think about another entry price at a lower price. But right now, things look good for Energy Transfer for the next 12 months with that price target of $12 to $14. So right now, I'm going to continue to hold my position and reevaluate once it starts to approach the price target. If you like this type of content, please consider subscribing. I do videos on personal finance, investing, and stock analysis, such as this one. If you found anything helpful, please hit that like button. It lets me know that I'm doing a good job. And if you have any feedback, leave it down in the comments below. Thank you so much for watching today's video. My name is Frank Finance, out.